Today I am going to take class on plus 2 accountancy part 2 accounting for share capital. A company is an association of persons who contribute money or money's worth for a common purpose, and the amount collected by the company or the company raises its capital means the amount that is required for the functioning of the company in the form of shares, and it's collectively known as share capital. We will now move on to the features of a company. The first feature is body corporate. A company is formed according to provisions of law enforced from time to time. Second feature is about separate legal entity. A company has a separate legal entity apart from its members. It can hold or deal with any type of property and also can enter into contracts or even open a bank account in its name. The third feature is about the limited liability. The liability of the members of a company is limited to the amount of shares contributed by them. The fourth point is about perpetual succession. The company being an artificial person created by law and will continue to exist irrespective of the changes in its members, and it can only come to an end by law. The death or insanity, so insolvency of a member of a company, in no way affects the functioning of a company. Then the next point is about common sale. The company being an artificial person can sign its name by itself. Therefore, a company is required to have its own seal which acts as the official signature of the company. Then transferability of shares. The shares of a public company is freely transferable. The permission of the company or the consent of any member of the company is not responsible for the transfer of shares. In the case of a private company, the shares are not transferable. Then may sue or be sued. That is, we can file a case in the name of company, and company can also file a case upon our name. A company being legal person can enter into contracts and can enforce contractual rights against the others. It can sue and be sued in the name if there is any problem in the contract. Then kinds of companies. On the basis of liability of the shares of the members, there are three types of companies: company limited by shares, company limited by guarantee, and unlimited companies. Company limited by shares, in the liability of the members is limited to the extent of the amount of shares held by them. Then, in the case of companies limited by guarantee, liability of the members is limited to the amount they undertake to contribute or the amount they guarantee to make payment to the company. Then unlimited liability. When there is no limit on the liability of the members of the company, it's known as an unlimited liability company. Then on the basis of number of members, the companies is classified into two types: public company and private company. A public company means a company which is not a private company and has a minimum paid up capital of 5 lakh rupees. Paid up capital I will discuss later. For such higher paid up capital or maybe prescribed, and is a company which is not a subsidiary of a private company. Then a private company and number of members of a minimum number of members required to form a public company is 7. A private company is one which has a minimum paid up capital of 1 lakh rupees or higher paid up share capital, and it restricts the rights to transfer its shares and limits number of members to 50. Minimum number of members to form a private company is 2. Then prohibits an invitation to the public to subscribe for its shares. Then prohibits an invitation to acceptance of deposits from the person other than its members, directors or relatives. Then categories of share capital. Share capital, as we have already said, it's the amount that is contributed by the public. The first type of capital is authorized capital. Authorized capital is the amount of shares that a company is authorized to issue by its memorandum of association. Memorandum of association is a document held by the company, and in that document it will be specified the amount that the company is authorized to issue raised from the public. The second is the issue capital. It is that part of the authorized capital which is actually issued to the public for subscription. The third is subscribed capital. It's that part of the issued capital which has actually been subscribed by the public. Called up capital. It is that part of the subscribed capital which has been called up on the shares. Then paid up capital. It's the amount of called up capital which has been paid by the shareholders. Then uncalled capital. It's a portion of the subscribed capital which has not been yet called up. Then the reserve capital. Reserve capital, a company may create or reserve a portion of its uncalled capital to be called on the effect of its winding up the company. Such uncalled amount is called reserve capital of the company. It is available only for the creditors on the winding up of the company. That's all for today's class. Thank you.